All right. So we're here basically to unpack the finding of our research. It's a white paper that is getting published today on the VC ecosystem. So this is basically the result of year-long conversations within 15 fund managers and a survey from 50 plus fund managers where we went out and tried to understand basically what is working and what is not working for them. Next slide. And basically to paint a picture, right, Africa, our ecosystem is young, our VC ecosystem is very young. As you can see, 60% of the fund managers are still on their first vintage within the VC landscape. Unfortunately, or fortunately, we very much mirroring an ecosystem that's been existing since the 50s, which is this tiny piece of land called the Valley, the Silicon Valley, which is, small, completely unified, that's been operating under a 10-year, 220 fund model since the 80s, where the federal government of the US decided to change the law from pension funds and actually force them to deploy within the VC market. And since the asset class needed something more predictable and standardized that pension funds were already used to, they decided to adopt the 10-year 220 model from the private equity industry. Yet, as we know, Africa is anything but small, unified. Africa is very fragmented. Purchasing power is low, infrastructure is scarce, and the continent needs a model for itself. So we went around, asked fund managers, next slide, asked fund managers what were their biggest concerns, what were their biggest constraints to do their job better and have better fund products for the founders that they want to back, but also to return capital to LPs. Interestingly enough, the main concern for 40% of them are LP requirements. So that's constraint around geographies, sector that they have to use. And essentially, you can see the four other items, so timelines, incentives, liquidity, and capital versus business need, which is everything that we unpacked in our research. So the first finding is basically that the fund timelines that we have are completely not suited for the African market. 60% of the fund managers operate under a 10 plus 1 plus 1 structure, which is actually a plus 1 plus 1 plus 1 plus 1 plus 1. That basically takes on average 15 to 17 years for a fund in Africa to be closed. So that's from start of deployment to fully exiting the portfolio. Basically because it takes longer. It takes longer to build a business in Africa than in the Valley. Most of our businesses actually do not have the underlying infrastructure that they can build on, so they have to create that infrastructure. And when we survey fund managers, 93% of them tell us that they actually have appetite for either an evergreen or at least a longer fund life period. But as you can see, among these 92%, 40% of them are saying, yes, we want it, but our LPs are not allowing to do so. Next slide. Second misalignment was around basically capital that is being used. 70% of the capital deployed in the VC ecosystem in Africa is actually equity. So it's either equity or quasi-equity because convertible notes in our ecosystem are unfortunately used as an equity product, even though they were not designed for that at all in the Valley. And there is very little debt or structured products that are being used in our ecosystem. What that creates essentially is a mismatch between the needs of our companies that are usually hardware heavy or logistics heavy or operationally heavy. And it also pushes valuations up because when fund managers actually invest equity in a company raising to fund working capital instead of debt, that pushes valuations up. And in markets like Africa where exit valuations are actually constrained, that actually hinders the performance of fund managers. And as you can see, when we speak with fund managers, 60% of them actually do have appetite to use blended models that would allow them actually to generate liquidity earlier. You can think revenue-based finance, you can think redeemable equity, or pure debt products such as working capital products that would, again, improve the liquidity of our ecosystem, and Kartik will speak more about it.
Yeah, thanks. So as you can see on the slide before, when we surveyed fund managers, illiquidity and exit pathways was a concern only 4% of the time. But I hope over the next few years that number will go up. And as Kola said this morning, DPI is sort of everything. I guess the point I want to make is that the pressure will build, right? We're in 2025 now, which means the 2015 vintage is now coming to a 10-year end. So now those investments will start to get realized. But the reality is that in 2015, the total amount of VC funding in Africa was only $200 million, right? And then we went from 2015, 2017, it increased, and then as you can see, all the way to 1.4 billion in 2019. So for me, when I see this statistic, it's very, very clear to me that as we saw a lot of this funding wave come through, what we will also see is a realizations wave, right? Which is a lot of that capital needs to go back into LP pockets. And so as such, one of the conclusions we had was that the pressure to deliver DPI over the next 5 to 7 years will reach levels that we have just never seen in Africa before. And so it is very important for us to start building out a lot of the fundamental infrastructure so that we can actually start delivering on our promise of returns and doing distributions. Obviously, when we surveyed more fund managers, we wanted to ask, well, how many of your portfolio companies do you think have a clear exit path? Now, these are blended vintages, right? Of some very recent fund managers, some slightly older fund managers, which means the businesses have matured, right? So they're approaching that age where the businesses can be exited. But it's really interesting that over 60% of fund managers that we interviewed had visibility on what the likely exit path would be in the next 5 years of only between 0 to 25% of their portfolio. And so when we see this, it really concerns us because obviously, as you all know, we're in the business of investing, but then we have to make money from our investments, right? And I feel like we're forgetting the second part of it. In the paper, obviously, we discuss a lot of exit mechanisms, so secondaries and M&A. They are a solution, but as we discussed earlier today, who really are the acquirers in Africa? And the challenge is that when we get to a period where there is lots of exit and realization pressure, we will just increase the supply of assets, which means the multiples on revenue on M&A are going to go down. The discounts on secondaries are going to go up, simply because there is more supply for this approximately same amount of dollars coming into the ecosystem. So this is something that we have to think about and start building for the future. The second thing is continuation vehicles. We've seen a lot of this being talked about this year. And while it's a good mechanism to allow a fund manager to go beyond the fund timeline and still hold a business, this really only is sort of a temporary fix. And we're kicking the can down the road in a lot of ways. Although there are merits to the approach, we also prevent the moment of exit to happen, right? And we push it into the future. Thirdly, structured exit mechanisms such as management buyouts. There are lots of companies now that find themselves in a position where they had raised $1 million, $2 million, $3 million 5 years ago that are profitable businesses, essentially the concept of seed strapping. And now they worry about how they're going to give an exit to their investors in the case that they don't want to separate themselves from their business. But the challenge is for those founders, there is just no way for them to be able to structure management buyouts because the banks won't lend to them and we don't really have the financial institutions that will allow them to do that. I guess the point we're trying to say here is that while we do have a lot of these exit mechanisms, we really have to start building, in my view, over the next 10 years, a good pathway from private venture-backed companies to publicly listed entities. And we're seeing a lot of that happen in different markets, as we saw earlier today. But I think we really have to accelerate that process. I know that talking about public markets in a VC early stage conference is it's kind of like an ugly child in the room. Nobody really wants to talk about it. But here's something that I'm receiving now from the founder community. I think if we don't develop public markets, we're setting a very dangerous precedent to VC in Africa. What we're saying to founders is that founders only have 2 options to delivering cash returns back to their investors, right? And these are the 2 options. They either continue to raise money in the private markets every single year or every 2 years to do secondary cleanups of their cap tables, right? Because you have to recycle that capital. Then you bring somebody else new in. And obviously, during that time, the business grows. So then you just have to raise more and more and more. But we're not seeing the growth curve happen on the funding side for that to be sustainable. And then the second thing is we're forcing the founders to separate themselves from the business if they raise any single dollar of venture funding at all. And I think that sets a very, very dangerous precedent. And in our view, this is not sustainable whatsoever. Now, while we have discussed exit mechanisms in the paper, I encourage all of you to think about how do we start activating some of those. And then just on IPOs, there's a bit of a joke, but can anybody guess the stock ticker and what that stock might be? It's up 275% in the past 6 months. On Friday, it was up 300%, but it went down a bit.
Go ahead.
Any guesses? Wild guesses?
Yes.
This is Jumia stock. So with that, I'm going to pass back to Alyune now, who's going to discuss the fourth pillar of our white paper.
So the last thing we looked at are basically incentives and fee structures within funds, African VC funds. When we surveyed fund managers, most of them tell us, and we asked them, what's the minimum fund size that they need to do their job properly? Most of them tell us that they need a $50 million fund, at least. Of course, most of the funds in Africa are smaller than that. Then we asked them, why do you need a $50 million fund? Does that coincide with the deal flow that you're receiving? And the answer is no. The fund size is a pure factor of the 2 and 20, but the 2 within the 20. And basically, that's the amount of management fees that they need to sustain teams and operations, especially in a continent where operations are expensive, and you need a lot of those in order to basically be able to affect the rate of returns or the rate of success of your portfolio. So what we're saying here is that there needs to be innovation also at that level. And yes, we discuss extensively in the paper mechanisms such as declining fees over time, so that you can front load in the beginning, performance-linked or tiered carry mechanism. Some fund managers tell us that they don't need a 2% management fee over a year, especially over 10 years, especially if they go for longer cycle vehicles, which is what they're asking for. And that could be budget-led, for instance. But the last, but probably also very important point to mention is around the waterfall and the carry structure. Most of our funds on the continent operate on the European waterfall, which clearly disincentivize fund managers. In the context of a market that is not liquid, as a fund manager, when you raise and you're in Fund 1, you'll maybe see carry in 15 or 17 years. That's clearly not attractive. Of course, going to raise a bigger fund, in 5 years and sustain management fees for 10 years is a bit more attractive. So there is a case there, and probably the only thing that we would need to borrow from the Silicon Valley model is actually the American waterfall, which is a deal-by-deal carry structure that allows you to generate liquidity at a deal level and distribute, and of course, to align interests with our LPs, institutional LPs, including DFIs. We can consider hurdle at the deal level. We can consider even a second layer of hurdle at the fund level, and even escrow mechanism. But at least we believe that there needs to be liquidity and incentive for GPs, that liquidity get generated early and get reinvested into the management company in order to grow the team and sustain operations. So essentially, the big message that we're sending in our paper, it's not only do evergreen funds. It's not only adopt the American waterfall. It's that we need more diversity in order to create a true ecosystem across VC funds, but we also need other products. We need evergreen funds. We need studios. We need CVCs. All of that will allow us to have diversity, which is actually what led to the success of the Silicon Valley model. You had shorter-term vehicle that was smaller, longer-term, but essentially our founders are building different type of companies in the African continent, and we need different type of products in order to serve them better, because that's only this way that we will be able to generate liquidity for LPs and truly create a self-sustaining ecosystem. So the paper ends basically with a call to action, both for fund managers and for LPs. For fund managers, if you were removed from all the constraints that we all know about, what type of fund products would you build? What is the best tool to serve the founders that you want to serve and that you want to work with? And for LPs, institutions, DFIs, when you receive a deck or a proposal from fund managers that looks slightly different from what you've been used to, take the conversation, question the status quo, and let's all, in doing so, build a true self-sustaining ecosystem. So if you scan the QR code, that will give you access to the interactive version of our white paper. It's a lovable website, and you can also download the full paper that is getting published later today by the Africa Arena team. Thank you very much, and together let's build a better ecosystem.